Hello, and welcome back to Boni's Life, your weekly dose of clarity in the chaotic world of crypto. If you're feeling a bit of whiplash from the market's recent mood swings, you're not alone. 1 minute, we're knocking on the door of a six-figure Bitcoin. The next, it feels like we're sliding down a never-ending snake in a game of snakes and ladders. But fear not, because today we're going to cut through the noise. We'll dissect the past week's turmoil, look ahead at a week packed with market-moving events, hear from the titans of the industry, and most importantly, arm you with the strategies to navigate these choppy waters. So grab your coffee, settle in, and let's make some sense of this beautiful madness. All right, let's first take a look in the rearview mirror. The past week in the crypto market has been, to put it mildly, a roller coaster. After flirting with the monumental $100,000 level, Bitcoin decided to play hard to get, tumbling down to its current price of around $78,300. And as you know, when Bitcoin sneezes, the rest of the market catches a cold. Ethereum followed suit, dropping to about $2,400, and Solana is hovering around the $105 mark. The total crypto market cap shed a cool $500 billion, now sitting at about $2.7 trillion. It seems the party got a little too wild, and now we're dealing with the hangover. This sea of red has plunged the crypto fear and greed index deep into the extreme fear territory. Now, for the uninitiated, this index is like a mood ring for the market. When it's green, everyone's greedy and euphoric. When it's red, like it is now, fear is the dominant emotion. While it's easy to get spooked when you see this, seasoned traders often see extreme fear as a potential buying opportunity. As the old saying goes, be fearful when others are greedy, and greedy when others are fearful. But, and this is a big but, it's not a magic 8-ball, it's a sentiment indicator, and sentiment can be fickle. So, we don't just blindly buy into fear. We use it as a signal to pay very close attention. Now, let's turn our attention to the week ahead, from February 2nd to February 8th. And folks, this is not a week to be on autopilot. We have a gauntlet of economic events that could send shockwaves through all financial markets, including our beloved crypto. Let's break it down day by day. Monday, February 2nd, we start the week with China's manufacturing PMI. Why does a Chinese factory report matter to your crypto portfolio? Because China is the world's second largest economy. A weak number there could signal a global economic slowdown, which typically makes investors shy away from riskier assets like crypto. Later in the day, we get the US ISM manufacturing PMI. This is a big one. It's been stuck below 50 for a while, which indicates a contraction in the manufacturing sector. If it stays there, it could weaken the US dollar, which in a strange twist can sometimes be good for Bitcoin. Tuesday, February 3rd, all eyes will be on the land down under as the Reserve Bank of Australia announces its interest rate decision. While they're expected to hold rates, any surprise or hawkish tone from Governor Michelle Bullock could ripple through the markets. Then we get New Zealand's employment data. A weak labor market there could add to global recession fears. Wednesday, February 4th. This is where it gets really interesting. We have China's services PMI, another key indicator of its economic health. But the main event is the Eurozone's inflation data, their CPI. Inflation has been the boogeyman for the past couple of years, and central banks have been fighting it with interest rate hikes. If the Eurozone's inflation comes in lower than expected, it could give the European Central Bank more reason to cut rates, which is generally good for risk assets. Then in the US, we have the ADP employment report, a precursor to the big jobs report on Friday. Thursday, February 5th. It's a central bank Super Thursday. We have interest rate decisions from both the Bank of England and the European Central Bank. The market is expecting a potential rate cut from the Bank of England, which would be a significant policy shift. The ECB is also expected to continue its path of monetary easing. Lower interest rates mean more liquidity in the system, and some of that liquidity often finds its way into crypto. Friday, February 6th. And finally, the grand finale of the week, the US non-farm payrolls report. This is the mother of all economic indicators. It tells us how many jobs were created in the US in January. A strong jobs number could mean the Federal Reserve might keep interest rates higher for longer, which is typically bad for crypto. A weak number, on the other hand, could signal an economic slowdown, prompting the Fed to consider cutting rates, which would be bullish for crypto. It's a delicate dance, and the market will be watching every step. So, as you can see, this week is a minefield of potential volatility. But with great risk can come great opportunity if you know where to look. Now, it's not just me telling you to buckle up. The titans of the crypto and financial world are also sounding notes of caution and opportunity. Let's start with Pantera Capital, one of the most respected venture capital firms in the space. In their latest blockchain letter, they dropped a bombshell of a reality check. The altcoin market has been in a bear market since December 2024. While Bitcoin has been relatively resilient, the broader token universe has taken a beating, with the median token down a staggering 79% from its peak. They point to issues like unclear value accrual for token holders and a rotation of speculative capital into other sectors like AI and even gold. But here's where it gets interesting. Pantera also sees a silver lining. They argue that with sentiment washed out, leverage flushed out of the system, and a year-long bear market for altcoins already behind us, the setup for 2026 looks increasingly asymmetric. They highlight the continued institutional adoption, with giants like JP Morgan and Stripe integrating blockchain technology. They also point to the supportive macro backdrop, with the Fed pausing its quantitative tightening. Their closing thought is powerful. Periods of dislocation have historically laid the groundwork for the next phase of growth. Other experts are echoing this cautious optimism. Analysts at CoinDesk are warning of a potential deeper pullback for Bitcoin to the $70,000 level. At the same time, we have the World Economic Forum declaring 2026 a defining moment for digital assets, and the IMF exploring how stablecoins can improve global finance. And let's not forget the regulatory landscape. The departure of Gary Gensler as SEC chair has been seen by many as a positive development, with hopes for a clearer and more crypto-friendly regulatory framework in the US under the new administration. So, the consensus seems to be that we're in a consolidation phase. The market is holding its breath, waiting for the next major catalyst. The long-term structural bull case remains intact, but the short-term is a tug-of-war between bullish fundamentals and bearish sentiment. So, with all this information, how do we actually trade this market? This is not financial advice, of course, but here's a playbook of strategies to consider for the week ahead. First, let's talk about key levels for Bitcoin. On the downside, we have a critical support zone around $84,000. If we break below that, we could see a slide towards the $80,000 psychological level and even the $70,000 to $75,000 range that some analysts are calling for. On the upside, the first major hurdle is to reclaim the $90,000 level. If we can do that decisively, it would be a strong bullish signal, opening the door to a retest of the recent highs around $98,000 and even a push towards that magical $100,000 mark. Given the high volatility expected this week, a range-bound strategy could be effective. This involves identifying the key support and resistance levels and trading within that range. For example, you could consider buying near support and selling near resistance. However, this requires active management and a clear stop-loss strategy to protect yourself from a breakout in either direction. For the more patient investors, this period of extreme fear could be an opportunity to dollar-cost average into your long-term positions. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the price. This strategy helps to smooth out the volatility and reduces the risk of buying at a market top. And finally, let's not forget about risk management. This is paramount in any market, but especially in a market as volatile as crypto. Never invest more than you're willing to lose. Use stop losses to protect your capital, and don't let your emotions get the best of you. The market is a psychological battlefield, and the traders who succeed are the ones who can stay calm and rational when everyone else is panicking. So there you have it, a jam-packed week ahead, full of potential pitfalls and promising opportunities. The crypto market is at a crossroads, and the direction it takes next could be heavily influenced by the events of the coming days. But by staying informed, understanding the key drivers, and having a solid trading plan, you can navigate this market with confidence. Thank you for joining me on Boni's Life. If you found this episode helpful, please hit that like button, subscribe to the channel, and ring that notification bell so you don't miss our next deep dive. And as always, I'd love to hear your thoughts. in the comments below. What are your predictions for the week ahead? What strategies are you using? Let's continue the conversation. Until next time, trade smart, stay curious, and I'll see you in the next episode of Boni's Life.